Good evening. Welcome to Mutual Fund chapter again. Now today's topic is INVITs. INVITS. Infrastructure Investment Trust. Okay. But in short it is written as INVITs. Easy to pronounce. Infrastructure Investment Trust. This is similar to Real Estate Investment Trust, REIT, but they invest in infrastructure projects. They invest in infrastructure projects. Example, highway, power, okay, solar energy, dams, roads, flyover, metro projects, airports, ports. So they are basically investing in those sectors. You cannot directly invest in those companies or those sectors. So what you can do, you can purchase the units of INVITs and indirectly you enjoy the benefits of the growth of these sectors. So with that objective, this INVITs, again one innovation in the field of finance, were introduced because public money is involved. SEBI regulation is also there to protect the interest of the investors. So this is INVIT. INVITs are infrastructure investment trust, similar to real estate, but their focus will be on infrastructure. Real estate investment trust, the focus was on commercial properties, are similar to REIT, with the difference that INVITs invest in income generating infrastructure projects as compared to REIT, wherein investments are made in income generating real estate assets. Basic fundamentals are same. INVITs will invest in income generating infrastructure projects. REIT will invest in income generating real estate assets. And then there is a SEBI notified SEBI Infrastructure Investment Trust Regulation in 2014. So we will see the important feature of this regulation. Mark very important, because we are going to solve a case study on this, okay, which was asked in one of the institute model test papers. So read it carefully, because then I am going to ask a question related to this. So what are the salient features of regulation? Infrastructure is as defined by Ministry of Finance. So the definition of infrastructure is given by Ministry of Finance via its notification dated October 7, 2013, and shall include any amendment or addition thereof. So take a mark. Who has defined infrastructure? Ministry of Finance, and will include any amendment or addition made in this definition later. INVIT shall be set up as trust. So second point worth remembering, the legal format, legal structure is trust and has to be registered with SEBI, and it shall have parties. Now how many parties are there? Trustee, sponsor or sponsors, means more than one sponsor is also possible. And this time there are two managers, investment manager, and under that there is a project manager. Investment manager looks after where will the investment be made. So he takes overall investment decision. Project manager looks after O&M. What is O&M? So they look after day-to-day operations and management. So this time, because it's an infrastructure project, it requires more manpower, more efforts, more management efforts. So therefore, investment manager, under that there will be a project manager. Project manager is for operation and maintenance. The trustee, what is the role of trustee? The trustee of INVIT shall be a SEBI registered. Shall be. He has to be a SEBI registered debenture trustee who is not an associate of the sponsor or the manager. Do you find lot of similarities in this regulation and REIT regulation? Yes. InvIT shall invest in infrastructure projects. Where will they invest? Infrastructure projects. Infrastructure has been defined by Ministry of Finance, which can be amended or altered or added, and it can also invest either directly or through SPVs. So they can float an SPV and they can invest through SPV. Now investment through holding company is allowed. So in case if you have a holding company, you can invest through holding company, and InvIT shall hold or propose to hold. Again underline, because there is a question on this. Institute can ask from any corner. InvIT shall hold or propose to hold controlling interest and more than 50% of the equity capital or interest in the underlying SPV. So what will be the stake of InvIT in the SPV? 50% of the equity capital. Okay, more than 50% of the equity capital or interest in the underlying SPV, except where the same is not possible because of the regulatory requirement or requirement emanating from the concession agreement. So 50% you underline. InvIT shall hold more than 50% in SPV unless it is not possible. Next is, in such cases, sponsors shall enter into an agreement with the InvIT. A sponsor shall enter into an agreement with the InvIT to ensure that no decision taken by the sponsor, including voting decision with respect to the SPV, are against the interest of the InvIT unit holders. Decision taken by sponsor will not be against the interest of the unit holders of InvIT. Okay, SPV, sponsor and InvIT will enter into an agreement that any decision taken with respect to SPV should not go against the interest of the unit holders of InvIT. Sponsor in bracket S means more than one sponsor is also possible. Of InvIT shall collectively hold not less than 15% of the total units of InvIT on the post-issue basis for a period of at least 3 years. Sponsor will hold 15% of the total units for at least 3 years, except for the cases where a regulatory requirement or concession agreement require the holder to hold a certain minimum percentage in the underlying SPV. So how much is the sponsor stake in the InvIT for the first 3 years? For at least 3 years, 15%, unless the regulation requires any other way. Next is, there is no limit on the number of sponsors. In REIT, what was the limit on the number of sponsors? 3. In InvIT, how many sponsors can be there? No limit. The proposed holding of InvIT in the underlying assets shall not be less than rupees 500 crore. This is there in REIT also. And the offer size of InvIT shall not be less than 250 crore at the time of initial offer of units. So initial offer will be of 250 crore, and then they should have an asset which should not be less than 500 crore. The aggregate consolidated borrowing, InvIT and its SPVs and the underlying SPVs shall not exceed 49% of the value of InvIT asset. Is it there in your REIT also? Why such limits are there? So that they do not depend on borrowing to a large extent. Okay, so if there is 100 rupees asset, maximum 49 rupees of that asset will be financed by borrowing. 51% will be equity financed. Further, for any borrowing exceeding 25% of the value of InvIT asset, credit rating and unit holders approval is required. Same in REIT also. Borrowing above 25%, credit rating and unit holders approval is required. An InvIT which proposes to invest at least 80% of the value of the asset in completed and revenue generating infrastructure project. So 80% of their value of asset will be invested in completed and revenue generating infrastructure projects, shall raise fund only through public issue of units, have a minimum 25% public float, and at least 20 investors. Underline. Now this is not there in the rate. Is it there? Search. This is not there. 80% should be there, but here it is, if you propose to invest at least 80% in the completed and revenue generating infrastructure asset, then it shall raise funds only through public issue of unit and minimum 25% public float, means at least 25% share should be with the public, and at least 20 investors, have a minimum subscription size and trading lot of rupees 10 lakh and rupees 5 lakh respectively. So what is the minimum subscription amount required? Here it is 10 lakh. If you want to invest, then minimum is 10 lakh, and thereafter the trading lot is 5 lakh, and then in multiple of 5 lakh above that. Distribute not less than 90% of the net distributable cash flow. So whatever they will earn, 90% of that will be distributed to the investor subject to applicable laws, at least on a half yearly basis. Through a valuer, undertake a full valuation on a yearly basis. These two paragraphs we have read in REIT also. Same as in, so you can mark which are common, because then they can ask you a question. Following provisions are common in REIT and NVET, except the following. So out of 10 you have to identify which of them are not common or which of them are common. So these two are common. You can check. Through a valuer, undertake a full valuation on a yearly basis and updation of the same on a half yearly basis, and declare NAV within 15 days of such valuation or updation. So once in a year valuation is required, and once in 6 months you have to do the updation. Declare NAV within 15 days of such updation or valuation. A publicly offered NVIT may invest the remaining 20% in under construction infrastructure projects and other permissible investment as defined in the regulations. So maximum 20% they can invest in under construction project and other investments. However, in investment in under construction infrastructure project, it shall not be more than 10% of the value of the asset. Same. N and O are also same. Next is an NVIT which proposes to invest more than 10% of the value of their asset in under construction infrastructure project shall. Now suppose you want to invest more than 10% in under construction infrastructure project, but in that case you are allowed to raise funds only through private placement and QIB and body corporates, and have a minimum investment and a trading lot of rupees 1 crore. So here public is not involved. Public is not involved because the risk is high in under construction projects. So the funds will be invested only by private placement. That means they will be sophisticated investor or qualified institutional buyer. Again, they have lot of money, power and resources to undertake the evaluation, or corporates. And the ticket size is also only rupees 1 crore, and have a minimum of 5 investors with each holding not more than 25% of the unit. So in case if you want to invest in under construction project more than 10%, following conditions are to be satisfied. Funds will be raised only through private placement or qualified institutional buyer and body corporate. Minimum lot is 1 crore, minimum 5 investor, and not even one investor will hold more than 25%. They can hold less than 25%. So these are the conditions, and distribute not less than 90% of the net distributable cash flow subject to applicable loss to the investor at least on a yearly basis. What was written earlier? Half yearly basis. Undertake full valuation on a yearly basis and declare NAV within 15 days of such valuation. So this is for under construction projects. Now conditions for InvITs investing in under construction projects. Paragraph Q. There are two types of projects: PPP, non-PPP. What is PPP? P, private public partnership. Private public partnership. Now it is very popular for development of infrastructure like airports, highways. Okay. Many airports in India or many highways in India are the private public partnership projects. Government says we can't invest so much. Private sector says why we should invest. So then the government gives them right to collect toll or charges, or government gives them some amount every year. Okay, because they have to recover their investment cost. That is PPP. So condition for InvITs investing in under construction project, if it is a PPP project, then it has achieved completion of at least 50% of the construction of the infrastructure project as certified by an independent engineer, or has expended not less than 50% of the total capital cost set forth in the financial package of the relevant project agreement. So in case if you are able to get a certificate from the engineer, then it should be 50% complete, or the amount that you have already expended should be 50% of your capital cost. Or means either or condition, 50% completion certificate or 50% of the expenditure has been incurred for PPP. And for non-PPP project, the infrastructure project has received all the requisite approval and certifications for commencing construction of the project. Whatever approvals, okay, certificates, qualifications are required, you have complied with all these, and now you are ready to go ahead. So risk is reduced. Okay, all necessary approvals and certifications are obtained. For non means public is not involved, only private sector projects. Non PPP means only private sector project, or where there is no partnership of government and the private party. And then as usual, like REIT, there is a long list of disclosure requirement also. Listing and disclosure requirement for InvITs. Listing shall be mandatory for both publicly offered and privately placed InvIT. Okay, an InvIT shall make continuous disclosure in terms of listing agreement. Listing is mandatory for both privately placed InvIT or publicly offered InvIT, and continuous disclosure will be required as per listing agreement. What are the disclosure requirement? Detailed provision for related party transaction, valuation of asset, disclosure requirement, rights of unit holders, etc. are provided in the regulation. So interested candidate can read the regulation further and they will see what are the detailed disclosure requirement. Do you want to read? No. Otherwise you can read the SEBI guidelines. However, for any issue requiring unit holders approval, any decision which is requiring unit holder approval, the voting by any person who is a related party in such transaction as well as its associate shall not be considered. So following parties are not allowed to vote if any decision relating to issue of unit requires unit holders approval. Who are not allowed to vote? Related party. Related parties are defined in the regulation of SEBI, and associates. Their vote will not be considered. Okay. Now you will find in your notes somewhere few pages investment plans and services. Investment plans and services. Okay. So here we are going to discuss something urgent and important. Investment plans and services. When you invest in mutual funds, they give you certain option under a scheme. Within a scheme also there are certain options given to you. For example, normally 3 options are given to you: dividend option, growth option, and dividend reinvestment option. So we will summarize what is covered in these 3 schemes and what will be the effect on NAV. Okay, then what will be the effect on your NAV and valuation? Most mutual fund scheme offer 2 options, dividend and growth. But in dividend also, a third option is also allowed by some schemes, dividend reinvestment option. So when you tick mark dividend or growth or reinvestment, understand the implications. There are different options within a scheme. There are different options within a scheme. So even if you buy, say for example, equity fund, Reliance equity fund, under that you have dividend, reinvestment and growth option. So they are part of the same scheme. They share the same portfolio. Therefore, portfolio returns are the same for all the 3 options. So the fund manager will invest the money in the same portfolio. However, they differ in the structure of cash flows and income accruals for the unit holders. If you invest in dividend plan, whenever the mutual fund will declare dividend, you receive the dividend in cash. If you invest in growth option, never dividend is declared in that scheme. And if you tick mark dividend reinvestment option, dividend will be received but in the form of units. So therefore unit holders cash flow is affected, unit holder taxability is affected. And in case of dividend reinvestment plan, the number of units held will be affected. So unit holder may earn more or less because of this. Now we'll come to first one, dividend payout option. What did you guess from this dividend payout option? It means whenever the mutual fund will declare dividend, it will be given to the investor in cash. It will be provided to the investor in cash. So either you will get a dividend warrant or the amount will be transferred to your bank account. Okay. So from time to time the fund will declare the dividend and the dividend will be paid to the unit holder. So his bank balance will increase. Will his number of units change? No. Only bank balance will increase. So such schemes even declare a dividend on a daily basis. So again there are different types of scheme here also, but not all schemes will offer this. Daily dividend, do you know that? Weekly dividend, monthly dividend, quarterly dividend, half yearly dividend, yearly dividend. Some of them ask you to tick mark what is the frequency with which you want dividend, and accordingly they pay the dividend. As they have rightly said, some schemes like liquid fund and debt funds even declare daily dividend subject to availability of profit. Don't be very happy when a company pays you dividend, when a mutual fund pays you dividend. NAV reduces to that extent. NAV reduces to that extent. Suppose the NAV is 50 rupees before dividend. Dividend paid 5. After dividend, NAV will fall to say 45 rupees. I have not taken into account the tax that they will have to pay. So earlier you are holder of 1 unit valued at 50 rupees. Now in your bank account you will have 5 rupees and you are holding a unit of 45. So still your value is the same. Still your value is same. But in fact I think you will lose some amount as dividend will attract taxation. If you are not paying, they are paying. So even if they pay, the NAV will reduce. So debt schemes need to pay an income distribution tax. Do you know that? Debt scheme has to pay DDT on the dividend distribution. The tax payment too reduces the NAV. So even though investor does not have to pay tax on dividend, but NAV will reduce because mutual fund has to pay tax on dividend. Their reduced NAV after dividend payout is called ex-dividend NAV. So ex-dividend NAV means after calculating, after deducting dividend and DDT, what is the NAV? After a dividend is announced and until it is paid out, from the announcement till the payment date, it is referred to as cum dividend NAV. Cum dividend NAV means if you buy the units during this period, you are also entitled to dividend. Is it right? So mutual fund use this as a very smart strategy for selling their units. Few days before they are going to declare the dividend, they will say buy the units. In next 15 days you will get 50% dividend. Those who don't understand this strategy, he will buy. Within 15 days, I'll get 50% dividend. But that person does not know that your NAV will also fall to that extent. In fact, more because of DDT. So you actually end up being a loser. Is it right? So if you invest in a mutual fund with the assumption that I will get dividend and earn immediately, you will actually lose because your NAV will fall. In a dividend payout option, the investor receives the dividend in his bank account. NAV goes down to reflect the impact of dividend paid and DDT. Dividend payout does not change the number of units held by the investor. Keep all these points in mind. Even while solving a NAV problem, we have solved one question in your batch that it was written if a company pays dividend of 0.80 per unit, what will be the revised NAV? Just reduce the dividend amount. If DDT is given, reduce that also. Do not change the number of units in a dividend payout option. The dividend received in the hands of the investor does not bear any tax as per the current tax laws. But tell me, I am not sure, if his dividend income is more than 10 lakh from mutual fund, is he supposed to pay tax on that also at a lower rate? In some income tax act, it was amended that if your dividend income is more than 10 lakh, it's only for shares, not for dividend not for mutual. It's not for mutual fund. Wow, I am happy. Next point. I will not disclose how much I earn from dividend. Why do you ask such questions? Dividend reinvestment option. Why should I tell you? Dividend reinvestment option. We have solved one question also on this. First you calculate the dividend. As usual, number of units held into dividend per unit. Is dividend you will receive? Divide by X dividend NAV. That is the number of units that will be reinvested. Okay. So here instead of receiving dividend in your bank account, your dividend will be converted into units. You will get additional units. Number of units held will increase under this scheme. So some investor they think, why should I take dividend? Again I will go to the same mutual fund house. Again I will invest. So instead of that, let the mutual fund only invest my money in the units. So thus, if a dividend of rupees 2 per unit on a unit holder 100 unit, he will be entitled to 200 rupees dividend. Assume that the X dividend NAV is 20, he will get 10 units. So now he will be holding 110 units after this dividend reinvestment. Now, does NAV decline in the dividend reinvestment option? Yes. The NAV declines to the extent of dividend and income distribution tax. Even on dividend reinvestment option, mutual funds are required to pay dividend distribution tax. Okay. Because from the government point of view, you have paid dividend, whether you pay in cash or whether you pay in units. So the resulting NAV is called ex-dividend NAV. Third type of scheme is called growth scheme. Do they pay dividend? No. Dividend is not declared in the growth option. Then whatever amount the mutual fund earns remains with the mutual fund. So NAV will keep on appreciating as the mutual fund earns more and more income. The investor benefits because the NAV appreciates here if the mutual fund earns income. So therefore nothing is received in the bank account unlike dividend payout option, and there is nothing to reinvest unlike the dividend reinvestment option. No dividend. Do not calculate dividend in a growth scheme. Okay, in the absence of dividend, there is no question of income distribution tax. In fact, it is good for the investors who do not want dividend income. Unnecessarily you opt for dividend and the mutual funds end up paying dividend distribution tax in some cases, which is a loss to both of you. And who benefits? That fellow, man ki baat. Okay. The NAV would therefore capture the full value of the portfolio gain. So whatever mutual fund earns, it is reflected in the NAV. So over a long period of time, it is observed that growth option gives you a very high rate of return. Because even the fund manager can plan from long-term point of view. When he will take a decision, he will also think that yes, this money will remain with us for a longer period. Whereas in dividend option, he has to keep some liquid money because it has to be paid to the investor in the form of dividend. So therefore, even the fund managers find it useful. Growth option, there will be no increase in the number of units held. The NAV of those units will however be higher to reflect the gain in the portfolio. So in the long run, NAV will continuously rise. Across the three options, the investor can also receive money by offering the units for repurchase. Suppose you want to get your money back. If it is an open-ended scheme, you can repurchase it. Go to the mutual fund house, ask it for repurchase. If it is a ETF or if it is a closed-ended fund, you can sell in the secondary market. Taxability would depend on the scheme type and the period of holding. In some cases, dividend distribution tax is paid by the entity, the mutual fund. In some cases, not. Investors are usually exempt from the payment of dividend tax. Okay, income from other sources will be exempt, dividend income. Long-term capital gain may have to be paid. Short-term capital gain tax may have to be paid. So now what we have done, we have made a comparison. Parameter, dividend payout option, dividend reinvestment option and growth option. Dividend received in the bank account, dividend payout option, yes. Dividend reinvestment option, no. Growth option, no. Income distribution tax, yes. For a non-equity scheme, yes. For a non-equity scheme, growth option not applicable because we don't pay dividend. Increase in number of units. Dividend plan, no. Reinvestment plan, yes. Growth plan? No. NAV change. NAV will decline to the extent of dividend and DDT. NAV will decline to the extent of dividend and DDT. And here the NAV captures the portfolio change entirely. Okay. Such important discussion is not there in ICI material. Okay. Similarly, three important plans which mutual funds use are not there in the ICI material. Systematic investment plan, systematic withdrawal plan, and systematic transfer plan. Okay. I didn't get your query. See, you are a mutual fund. You have invested in shares. The shares will pay you dividend. No, this was not reinvested. This will remain with the mutual fund. Dividend earned by mutual fund will remains in the mutual fund only. Dividend paid by mutual fund to the investor can be reinvested in the same mutual fund. No. If mutual fund receive dividend from companies where they have invested, that remains in their bank account. If that income that can be distributed, and then if the investor has opted for reinvestment plan, then it will be reinvested here. So dividend can be reinvested, capital gain distribution can be reinvested. That is your query? Then it is right. Because whatever they will distribute, there are two options given to you. Either you take it in cash or you can reinvest. So whether it is a distribution of dividend or distribution of capital gain disbursement, you can be given an option to reinvest them. This only. That is also this only. Why equity dividend is paid? Equity dividend tax is so harsh. Oh, you are deviating from our topic. Your question does not relate to our topic. Why government charges DDT? Okay. I don't know. Right now we'll not deviate from our topic, okay? There are logic, but let us keep ourselves to mutual fund. Why dividend distribution tax is charged like this, okay? But don't ask this query right now. Right now, systematic investment plan. Okay. Your query will be answered later. Wait. First SIP. First take a SIP. Okay. What is SIP? Suppose you earn 5,000 rupees every month in stipend. Every month you are getting 5k without any TDS or profession tax. Okay. Full amount you are earning. So what you can do, you can invest in a mutual fund systematic investment plan. So what happens? Every month you invest a constant amount. You can decide for how many months you want to invest. They may have a minimum, say 10 or 12 months option or 10 or 12 installment. So the advantage of this is that it will promote a regular saving habits. And you can even increase this amount after a certain time if you want. So that is SIP. It's like your bank recurring deposit account. The advantage is that you take the benefit of averaging. Sometimes the NAV would be high, so you may get less unit, but sometimes the NAV may be low, so you may get more units. So your cost is averaged out. Cost is averaged out, but more importantly, it promotes the saving habits among large number of people. And you don't have to do anything. You can just give them an instruction. The amount will be transferred from your bank account, or you can give them post-dated checks also and forget it. But yes, you should keep the balance in your account on that day. So it is considered a good practice. Ask your boss only to start your SIP, okay? So you don't have to take from him only. It is considered a good practice to invest regularly, particularly into volatile markets such as equity market. So it will help you to average out your cost also. Sometimes you pay at a high rate, sometimes you pay buy at a lower rate also. So SIP is an approach. Where is value 5,000 decreasing? Oh, that my diagram is okay. I'll remove it. You are wasting time. This is just a diagram. You can increase the SIP after some time. Nowadays there are every options available. I'll tell you. You have to only imagine. Okay, the limit is on your imagination. Mutual fund will create a product for you if you want. Yeah, if people like you demand an inflation based SIP, they can even create a product like that also. So I will forward your suggestion to some of the top mutual fund houses tomorrow morning, and maybe who knows, one new scheme will come. SIP with inflation adjustment. Okay, they can. It's all a matter of planning a scheme. So SIP is an approach where the investor invests constant amount at regular interval. A benefit of such an approach, particularly in equity scheme, is that why you should invest in SIP. One is your regular investment habit. Second, it is that the averages the unit holder's cost of acquisition. Since more units are bought for the same amount of investment when the market prices are down, and fewer units are purchased when the prices are high. So sometime you will buy at a high NAV, sometime you buy at a lower NAV. So it averages out your cost. So that is called rupee cost averaging. That is technically called rupee cost averaging. Now suppose an investor wants to invest 1000 rupees for 6 months. NAV is 10 rupees. In the first month, he'll get 100 units. In the second month, NAV is 12. He'll get 83.333 units. Third month, NAV is 9. So now he'll get 111.111 units. So if you do the calculation of average cost, it will be averaged out. Thus, the investor acquires his unit at lower than the average of the NAV on the 6 transaction dates during the 6 months period. A reason why this approach is also called rupee cost averaging. So you get the benefit of market changes also. Systematic investment allows investor buy into volatile market over time at an average price without having to predict the market movement. This is a very good scheme for people who want to save regularly, like salaried people who get a fixed income every month, and if they want to save, good scheme for them. Every month the mutual fund will deduct 2000, 4000, 5000 rupees from their bank account, and it gets invested in equity. So in the long run, it generates a very high rate of return for the investor also. But in the long run, okay, mutual funds make it convenient to lock into SIP by investing through post-dated check. Suppose you are comfortable with that, you can give 12 post-dated checks. But nowadays it is better you go with this option, ECS or standing instruction. So the amount will be debited to your bank account periodically. So that is called SIP. In SIP, you have to pay a fixed amount for certain number of months. Thereafter, if you want, you can increase or decrease the SIP amount. But you can't put random amount in that SIP. Random amount means 1 month 12,335. Next month 11,995. That you cannot do. Again, there are different types of scheme here also, but normally they will prefer a constant amount, and you have to tell them that you want to increase the SIP. What is the harm to them? I don't know. Let people invest whatever they want to invest. Is it right? My strategy would be, if I start a mutual fund, invest as long as money is coming in, I am happy. Is it right? I'll start after some years. I will start. Till that time, let me teach financial services and capital market. Thank you for your kind suggestion. Next is systematic withdrawal plan. Reverse. What is reverse of systematic investment plan? You suppose deposit 10 lakh rupees, and then you can instruct the mutual fund that transfer every month 5,000 rupees to my account. Or you can say every month redeem 1000 units. So whatever will be the value of 1000 unit on that day, on that date's NAV, they will calculate and transfer the amount to your account. So here also you are benefiting from the growth of the equity market, because remaining amount remains in the equity. If the NAV goes up, the value of your investment also keeps on appreciating. And plus you don't have the tension of removing the amount from your bank account or this or that account every time. You don't have to worry. Everything. Interest means that appreciation in the NAV you are enjoying. Your money, you don't get interest. No interest. But as the NAV appreciates, you get benefit of that. Just as investors do not want to buy all their units at a market peak, they do not want to risk redeeming all their units at a market trough also. So one advantage is that some units will be withdrawn at a higher rate, but at the same time some units can be withdrawn at a lower rate also. Investor can therefore opt for safer route of offering for repurchase a constant value of units over a period of time. So that is very popularly called SWP. You can tell the mutual fund that I want to redeem 1000 rupees per month. See, if NAV is 10 rupees in the first month, they will redeem 100 units. 12 rupees second month, they will redeem 83.333. So here you are gaining. Can you see that? As the NAV goes up, you only have to redeem lower number of units. But if the NAV goes down, they will redeem more number of units. So it averages out. You get the benefit of average. Thus the investor repurchases his units at an average NAV during the 6 months period. If suppose the NAV was 9 and you redeem all the units on this day, then you will suffer the losses. So investor does not end up in unfortunate position of exiting all the units in a market trough. SWP for you. Or people who retire, it is good for them also. Mutual fund make it convenient for investor to manage their SWPs by indicating the amount periodically, generally monthly, and period for their SWP. For how many months you want, for how many years you want, you can indicate to them. How much amount you want, you can indicate to them, and accordingly they will transfer the money to your account. Such schemes even offer the facility of, see the advantage, transferring only the appreciation or the dividend. Suppose you invested 1 lakh rupees, the value of your units is 1,10,000. So there are schemes which will say, the moment the value exceeds my amount invested, excess amount should be transferred to my account. So every time the value goes up, the appreciation, to that extent the units are transferred to your account. Accordingly, the mutual fund will repurchase the appropriate number of units of the unit holder without the formality of having to give a repurchase instruction for each transaction. So if you tick mark this option, you save a lot of administrative hassles. Otherwise, you have to send a redemption request. Suppose you want to book your profit, then you have to send a redemption request. But if you tick mark systematic withdrawal option, whenever market value appreciates, transfer to my account, they will do it. So what is the advantage? Immediately it will be done without you have to do anything. The question is why we should tick systematic withdrawal plan. One, minimize the risk of redemption all the units during a market trough. Means when the market is low, you don't have to redeem all the units. You have to redeem only some units. Sometimes you may end up losing all your money when you sell when the market is at the lowest level. Second reason is good for people who need funds on a regular basis. Third is, assuming the scheme is profitable, the repurchase ensures that some of the profits are being regularly encashed by the investor. But there is an assumption written. If suppose the scheme is profitable, under this plan you are booking some profit on every reinvestment date, every withdrawal date. Because NAV will go up. When you redeem, you are booking some profit. Every time you redeem, assuming that NAV is going up, you are booking some profit. How? Already told to you. First 1000 unit divide by 10. So 100 units were redeemed. But suppose the market goes to 12 rupees. Then you are only going to redeem 83.33 units compared to the last time when you had redeemed 100 units. Less number of units redeemed is a gain to the investor. Means you are booking the profit. Then debt schemes are subject to income distribution tax. One more thing you understand, from tax point of view, you are champions. If you suppose invest in a debt scheme which pays dividend, every time they will pay dividend, company will have to pay dividend distribution tax. But if you opt for systematic withdrawal plan, there also the money will be transferred to your account, but it will not be treated as dividend. It will not be treated as dividend. It is not dividend. They are transferring your money only to your account. So you'll have to pay only capital gain tax if applicable. And capital gain is charged at a lower rate. Okay, but again you have to check what is the capital gain tax rate. So this was about SWP. One more important scheme, another innovation is STP. What is STP? Systematic transfer plan. You have invested in debt. You think equity is better. Okay, option 1, redeem debt, then add invest in equity. This is what you will do. Now what is the problem here? If you redeem debt separately, you may, not must, exit load. And you may, but not must, pay entry load. For the time being in India, the regulation prohibits entry load. But that is a regulation which can always be changed. Second thing is that you will send the redemption request here on Monday. You will redeem on say Monday, Tuesday, 3 working days, Friday, no, Thursday. So Thursday the money will come to your bank account. Thursday or let's say Wednesday the money will come to your bank account, and then that will go into equity. Again when you will send money, it is not that immediately they will give you the units. It might take 1 day to again issue you the units of equity. So 3 to 4 days are just wasted. Can I offer you a simple solution? You just shift the money from debt fund to equity fund. So there are instructions now. If you see the website of mutual fund, whether you want to redeem, purchase or switch, this is like switch. So the moment you do the switching, immediately the amount will get transferred from your debt fund to your equity fund. Good scheme. Sometimes what they do, they say this is your mutual fund. This example you have understood. Instead of routing it like this, you can directly transfer. So the name is also appropriate, transfer plan. Sometimes you have invested in a mutual fund scheme and you have opted for dividend plan. We have seen dividend plan. What you can do, you can give an instruction to the mutual fund that whatever dividend I earn, you transfer that to another scheme. So this may be said debt fund. Dividend portion, you can take that much risk. If you tick mark that option, every time the dividend that they give you is converted into equity and transferred to some another scheme. If it is same scheme, it becomes dividend reinvestment plan. So it is similar to dividend reinvestment plan, but it is across the scheme. Okay. So that is called systematic transfer plan. Otherwise, they will pay you dividend. You will go and again purchase fresh units. There is a time lag. During this period, the rates can change. So that is systematic transfer plan. So this is a, you can say, combo package of SIP and SWP. On one hand, you are giving an instruction of withdrawal every time that they pay the dividend, and you are also giving an instruction to invest in another scheme. So this portion is like SWP and this portion is like SIP. So SIP plus SWP is STP. Okay. So this is a variation of systematic withdrawal plan. While in SWP, the constant amount is paid to the investor at the pre-specified frequency. Now here there is no pre-specified frequency. At the most, you can say whenever they pay the dividend or capital gain disbursement, you transfer that to an equity scheme. In an STP, the amount that is withdrawn from a scheme is reinvested in some other scheme of the same mutual fund. Then you should not ask, can I transfer money from HDFC mutual fund to Reliance mutual fund? That you can't do. In that case, you have to compulsorily redeem the first and then invest in the other. So that is not right now possible. Future it can be possible. Thus it operates as a SWP for the first scheme and SIP into the second scheme. Since the investor is effectively switching between the schemes, it is also called switch. So if you see the websites of mutual fund, and they will give you purchase option, redeem option, switch option, which means in that case you want to switch from one scheme to another scheme. The unit holders end up, suppose you do it yourself. If the unit holder were to do this SWP and SIP as separate transaction, you are CA final smart student, you say no, I will do myself. It is like you have to first withdraw, redeem, take few days, wait for few days for money to come to your account, again invest, wait for few days for the units to come to your account. In the meantime, the market rates may change, positively also, adversely also. And then you have to do double paperwork. Nowadays paperwork is not there, but still double administrative efforts are involved for every transaction. The STP offered by the mutual fund is a cost-effective and convenient facility. It can be used by the investors to make periodic investment into a volatile market such as equity, or to rebalance a portfolio, or to book the profits. So according to your risk taking skill, your understanding of the market, you can decide the systematic transfer plan. Okay. And there is no fixed pattern here. Whenever you want, you can do it, or maybe you can give a standing instruction for transfer of some portion to another scheme periodically. Investor can choose to transfer a fixed amount each period. One option, transfer every month 10,000 rupees to this scheme, or transfer only the appreciation amount to this scheme, or transfer the dividend amount to this scheme. A switch is a redemption from one scheme and purchase into other combined into one transaction. So it's basically a combo. It saves time and cost, efforts. For investor who believe that equity markets have peaked, in India, suppose you think that now it won't go further, and now you want to book the profit, you can switch out from the equity scheme and move into a short-term debt fund, and it won't take much efforts. If you do it separately, each transaction, then it will take some time. Okay, and by that time you invest in another, the NAV of that other scheme might have changed. Now we will discuss two case studies. Case study number 1, 50 marks from your exam. This is one exam problem. You can see the size of the case study. It runs into 3.5 pages only. So how to solve case studies problem? First of all, you should have prepared your syllabus well. That means you should have conceptual clarity, because you will see some questions now which, in spite of open book exam, you will not be able to get those answers. That will require your own understanding. Read the case study carefully, search for the hints given in the case study, try to use your own logic to solve. Okay, and in case if you have an open book exam, then you have to identify this concept relates to which topic, which provisions, and if required you can go there and check, right? So we will see, and you will be able to answer most of the questions. Now after this detailed discussion on mutual fund topic, which is a practically useful topic, so what on the screen will happen? First we will read the full balance sheet given to you, and below that balance sheet there are questions. So we will take one question and discuss the answer. Then we'll go to next question and discuss the answer. So there are about 30 questions below the case study, 25 to 30 questions, ranging from 1 mark, 2 marks, 3 marks. Okay, but it is very easy, you will be able to solve. So first case study, there is a balance sheet. I will read from your book. Okay, such a big balance sheet. The following data relates to a mutual fund on 31st March 2018. Right hand side 2 column, quantity and value. Quantity, unit capital. They don't write share capital, they write unit capital outstanding at the beginning of the year, issued during the year. Can you see there is a large number of units issued during the year and then redeemed during the year. So can it be a closed-ended scheme? No, because in a closed-ended scheme you can't have issues, redemption. Okay, and then outstanding at the end of the period. Below that, reserve and surplus, unit premium reserve, balance at the beginning of the year, then net premium or discount on issue or redemption of unit, then balance at the end of the year. If you see net balance at the end of the year 94870, that is the total of the above two. Then there is an unrealized appreciation reserve. Balance at the beginning. Change in the unrealized appreciation in the value of investment, and balance at the end. So this is the change in the investment value which they have to record. And then retained surplus. This is the current year profit. Balance at the beginning. Transferred to revenue account. Then if you look at this number, surplus transferred from revenue account, which means they have made a huge amount of profit in this year, 19,65,669. Can you see that number? And then balance at the end, which is the net total of the above three lines, which means this mutual fund is making profit. This mutual fund is making profit, as you can see, from surplus transferred from revenue account. Then current liabilities, amount due to AMC for management fees, others. Sundry creditor of units redeemed by investors. Lateral shift payable. Underline lateral shift payable. This means it seems they can transfer funds from one scheme to another scheme. Others, contract for purchase of investment, inter-scheme payable, dash, dividend payable on units, dash, dividend distribution tax payable, dash, unclaimed dividend, dash, unclaimed redemption, dash, unit application pending allotment. That is simple. That is, some investors may have applied, but the units have not been issued. Investor education expense provision, interest on borrowing. Other current liabilities, then investment, listed debentures and bonds. Some alignment problem is there in the presentation. Listed debenture and bond, government securities, total. Then deposits with scheduled bank is 0. Can you see the deposit with scheduled bank? 0. And other current asset, balance with bank in current account, sundry debtor for units issued to investor, lateral shift receivable, others, inter-scheme receivables, margin deposit with Clearing Corporation of India, tick mark. There is a question on that. 0. Margin deposit with Clearing Corporation of India. Outstanding and accrued income, amount due from AMC, collateralized lending, tick mark, collateralized lending, tick mark. And see the investment in debenture and bond, investment in government securities, and collateralized lending. Is there any investment in equity share in this balance sheet? There is no investment in equity share or equity related instrument. Major portion of your asset side is comprising of the listed debenture and bond, government security, collateralized lending, and outstanding and accrued income. Means they may have to receive the interest on these bonds and debenture. And then interest, money market instrument, some amount, debentures and bonds, some amount, deposits, government security including treasury bill, and collateralized lending, less interest on borrowing. So this is their asset side, which you will find most of them are debt oriented securities. The average expense ratio including management fees amounted to 2.65%, which also included GST, Gabbar Singh tax. So without GST, what is the expense ratio? Divide 2.65 divided by 1.18, 2.24, assuming 18% GST. So there is a question on this GST thing also. Answer the following question and reason out your answers. First question now. Under what type of mutual fund product would you classify the above? Why? Now, if you start searching for the answer in the book you will not get it, because this is a case they have designed, and only by reading this balance sheet you have to judge. So if you look at the balance sheet, you will find the asset side only comprises of debt. They have invested in debenture, bond, government security, money market instrument, debenture and bond, treasury bill, etc. You will not find investment in equity or equity related instruments. So you will say the answer is the mutual fund discussed in the case study is a debt oriented scheme. The reason is that its investment include listed debentures and bonds and government security. Question number 2. Is the scheme open or closed ended? Open ended. Why? So the answer of that question is, although not specifically stated in the case study, it seems that the scheme is an open-ended scheme because of the following reasons. The number of units issued and redeemed during there has been given in the case study. Because for last 4 or 5 days you are learning this chapter, you are able to guess it quickly. And if you think that it's an open book exam, I will be able to solve, I again warn you, not possible. Such question you can answer only after conceptual understanding. And the high amount of redemption, about 25% of the units outstanding at the beginning of the year, indicates that the scheme is an open-ended one. So even though you can't write this sentence, but at least you can write that there are units issued, there are units redeemed. Nowhere in the problem any fixed maturity period has been mentioned. So it can't be a closed-ended scheme also. Lot of changes are happening in the current scheme. So that is why it is an open-ended scheme. It is average. On an average, the redemption is roughly 25% of the opening. You don't have to prove it is from the opening. That is why that sentence you may not write. But at least you can write that there are issues, there are redemptions, and that is an indication of open-ended scheme. Can it be assumed without any contradiction that the product is traded in the stock exchange? Can it be assumed without any contradiction that the product is traded in the stock exchange? How? Which reserve? Premium reserve. So as you know, only closed-ended schemes are required to be listed. You have written the first answer, open-ended scheme. So therefore you can't say that it is a closed-ended scheme, because closed-ended schemes are listed on the exchange. Exchange traded fund. The answer is again no, because then margin deposit with the Clearing Corporation of India, because if you want to get yourself listed, some margin money you have to keep with Clearing Corporation of India. That balance is zero. So both the options we have ruled out. It can't be a closed-ended scheme because you have said it is an open-ended scheme. It can't be an ETF also because there is no margin with the Clearing Corporation of India Limited. So that is why I said you take mark. Next is switching between plans permitted in this mutual fund product? Now if you look at the two balance sheets, assets at two sides, there are lateral shift payable and lateral shift receivable. Okay, inter-scheme receivable, something like this is given, inter-scheme payable. So that can be treated as yes. The plans are permitted as lateral shift receivable and lateral shift payable is given in the case study itself. An indication that switching between plan is permitted in this mutual fund product. Why is there a nil balance in deposit with scheduled bank? Why there is a nil balance in deposit with scheduled bank? Because you have balance in current account. So you don't need deposit in scheduled bank. You have some balance in current account. If somebody wants to say redeem, you can use the current account. And plus you have lot of other liquid assets also. But some money you have to keep in current account. If somebody comes, then you have to redeem, no? And plus they have some investment in money market instrument also. Treasury bill also. So in case if somebody comes for redemption, they can use it. So this way you have to guess the answer. There is no right or wrong answer every time. So the answer of this question was only liquid fund schemes need to hold substantial amount as deposit with scheduled bank. This is not a liquid fund. It is a bond fund. Very good answer. It needs liquidity to the extent of repurchase of units being open-ended, and this is available in the current account balance. Probably on an estimated basis depending on the usual redemption demand by the investor. Value of units pending allotment should be deposited in a scheduled commercial bank. Alternate. That application money. So that has been deposited in the current account. Anyway, that line was not required only. Alternative answer you can present like this. Nowadays institute is giving two answer to the paper checker. If you have written this answer also, they will give you mark. And if you write this answer also, they will give you mark. One of the reasons that there is a nil balance in deposit with scheduled bank is that there are many payable items in the liability side of the balance sheet, which is an indication that the fund has no cash in the scheduled bank. So there are all small liabilities. The reason why the small liabilities are arising, it means your cash balance have been used. So therefore you are not keeping a deposit with scheduled bank because all your money has been used, and that is the reason you have so many small liabilities appearing in your balance sheet. Next is but that first answer is better. You write that first answer. Do you think that the scheme is a safe investment with negligible risk? Would you expect high return from this product on an annualized basis? So if you have said this is a bond fund, it means the risk is negligible, but you can't expect a higher return. 3 marks for this much effort. The scheme cannot be said to have negligible risk. Since almost half of the investments are in government securities, let me read why they have written. And there is other half in the listed debenture and bond. If the listed securities are risky, that risk will be directly affected the riskiness and exposure of the scheme. So you can just say there is minimum risk because these are all debt securities. 50% or more is government security. Some is in listed debentures and bonds, which may involve some risk. Again, the opinion can vary. You can just take a diplomatic stand that there is a very low level of risk because you have debenture issued by corporates. Okay, government bonds yield low interest and high safety. Similarly, the other investments are also listed debenture and bond, which gives less than equity investment return. Hence, the overall scheme of the risk of the scheme can be said to be moderate. This is what we have to write. Or low risk. And collateralized lending and receivables are high. Since the fund is a bond fund scheme, it may be presumed that the lending is against similarly secured collaterals. Other alternative answer. Yes, the scheme is a safe investment with negligible risk as it is a debt oriented scheme. Student is confused. What should I write? Whatever you write, you justify. Higher return on annualized basis is not accepted from the scheme because investments are entirely debt oriented. We can assume listed debentures and bonds are highly credit rated, so risk is negligible. So this answer you can write. Yes, you can assume. What is your comment on the expense ratio given above? Expense ratio is 2.65, which includes GST. Normally for debt oriented scheme, the expense ratio should be low. Okay, expense ratio should be low, because here you don't have to apply too much of say efforts to purchase. The expense ratio is on a higher side, because the current mutual fund scheme is a debt oriented one. All answers are linked, which involves lesser buying and selling in comparison to equity, and therefore should have a lower expense ratio. You can also present like this. This is also enough. Debt oriented scheme should have a lower expense ratio. 2 point some percentage is very high. As a measure of investor protection, SEBI has set the limits on recurring expenses which can be levied on the scheme of the fund. And these two limits you can remember. For equity oriented scheme, the expense ratio should be 2.5%, and for debt oriented scheme 2.25%. Somewhere in the notes this equity bond had come in one of the paragraphs, but debt had not come. But that time I had only explained it to you. But still, if I remove the GST component, it is something like 2.25 or 26. But that is the highest that is allowed. Any service charge or GST will be in addition to the above limits. Okay. In the above case, recurring expenses have been limited to 2.25% since it is a jet fund. Prima facie 2.65% in the question includes GST of 18%. If this element is excluded as required by the risk, the expense ratio works out to be slightly lower than 2.25%, which you said 2.24%, right? Which is permitted by the SEBI. Hence, the fund has been incurring expenses within the SEBI limit. Schemes are also permitted to charge, underline because this was not in the main note. Schemes are also permitted to charge an additional 30% of the AUM depending on how much of the funds or the scheme mobilizes resources from locations beyond the top 15 cities in the country. So they are allowed to incur some more expenses if they raise funds other than the top 15 cities in the country, because it has been observed that most of the investments are coming from top 15 cities. So some additional expense ratio they can incur. Okay, next question. Can you find the NAV per unit of the scheme from the given data as on the closing date? Substantiate with appropriate calculation and explain how you can or why you cannot find the NAV. So you should say, we cannot calculate NAV because listed debentures and bonds are given, but their market values are not given. Market value for other investments are also not given. So in the institute suggested answer, they have simply surrendered. As the market values of various investments are not available, NAV cannot be found out. Okay. But otherwise you can calculate on the book value in that case. In the exam, to be on a safer side, take the book value of all the assets minus liabilities, divide by number of units. Also write down below, since the market values are not available, book values are assumed to be closer to market values. What is the role of unrealized reserve? Is it not contrary to the fundamental accounting principle of prudence? Now this is not there in our study material of the institute. But they have asked a question. That means you should know accounts also. Accounting of mutual fund. But accounting of mutual fund entities are not there in your syllabus. Okay. So what will you do? So unrealized reserve is a concept which means as the value of the investment goes up or comes down, they increase or decrease the value of the investment. Investment account debit to unrealized reserve account. Investment account debit to unrealized reserve account is the value of increase or decrease in the value of the NAV of the units represented by the unrealized gains net of losses due to increase or decrease in the value of the investments of the scheme. So our institute have issued one guidance note for mutual fund companies, and at the end of the year, whatever investments they have made, they have to bring it to the market value, that is called mark to market, and investment account debit, unrealized reserve account credit. This is necessary to find out the NAV of the unit on a daily basis. If you bring your investment to market value, you can calculate NAV from the balance sheet. Is it right? That is why I said in the exam you can solve the problem for NAV, previous answer. Take all assets, because normally they do mark to market at the end of the year, which means we can assume that the investments are close to their market value. They have to do mark to market. What is mark to market? Value of the investment will be brought to the market value at the end of the year. This is necessary to find the NAV. Since it is unrealized and clearly demarcated, it is not considered as realized profit and hence not available for distribution as dividend or like retained profit. Because it is an unrealized gain, it is presented separately in the balance sheet. Alternative answer. Unrealized reserve may be on account of valuation of securities. Same thing, to depict the actual position of the fund. Okay. Mutual funds have to increase or decrease the value of their investment in the balance sheet. This is called mark to market. The figures given in the questions are not audited balance sheet as per Indian accounting standard or convention, which discourage the booking of unrealized gain. Therefore, it is contrary to the fundamental accounting principle of prudence, which state that to provide for all future losses and expenses but ignore all future profit. This answer to my limited knowledge is not correct, because there is guidance note which earlier was there in the CA final syllabus. We used to pass this entry, unrealized reserve entry, and we used to show it in the balance sheet. Yes. From the given figure, do you conclude that the scheme has performed well during the year in the question? Yes. Very tricky question. So the only information that is available with us is the surplus transferred from revenue account. So revenue account is the profit and loss account, which is very high, 19,65,669 at the top, rupees in 1000. Yeah, so you can say that yes. Number of units cannot be the reason for showing the profit. It is like if I issue the share, I have not made the profit necessarily. Number of units issued and number of units redeemed, they cannot give you the assurance that the company has made the profit. If suppose a company issues 10 lakh shares and buybacks 30,000 shares, does it guarantee what profit they have made? No. So there is only one source of this information. You have to look at their P&L account. Unit issued and unit redeemed cannot give you an assurance about the profitability. Why you can assume? NAV is going up. NAV can go up because of the increase in the market value of their investment. Is it right? Not necessarily due to the profit earned by selling the investment. NAV can keep on appreciating as the value of the investment appreciates. That is not a realized gain. Realized gain you can see in the surplus. So you should say the fund has performed well during the year as surplus transferred from revenue account. An increase in reserve is an indication that the mutual fund has performed well during the year. Can this fund borrow money from money market to meet the investor's income expectation or redemption obligation? Now this question you can answer from SEBI guideline, which is chapter number 16. Okay, because there the SEBI has given guideline on the borrowing, etc. This fund cannot borrow from the money market. However, they can invest in money market instrument for money market mutual fund schemes. You tick mark that question and search for the answer in the SEBI guideline. Mutual funds are permitted to borrow. So this is SEBI guideline. Mutual funds are permitted to borrow up to 20% of their net asset owned for redemption or dividend payout. Regulation 44 of mutual fund regulation. This also explains why the fund has no balance in the deposit in the scheduled bank. So up to 20% they can borrow. Okay. But the question was, can they borrow from money market? So the answer of that is they cannot borrow, but otherwise they can borrow. What can you say about the entry load and exit load of this fund? Don't read the answer. Read the question and tell me, do they charge any entry load or exit load or both? So you should say the question is silent. From the given information, do you find there is any way we can make a guesswork about the entry load and exit load? So the answer is there is no hint regarding entry load and exit load. So there is no hint. Interest scheme receivable and payable cannot be the basis for entry load and exit load. Okay, but at the same time you can write this SEBI regulations. There is no entry load on any product because as per SEBI guideline, mutual funds are not allowed to charge entry load. At least this much you can write. However, it is up to the individual schemes to charge an exit load. Normally, no exit load is charged in a tax saving scheme or a liquid fund or an exchange traded fund. Since the objective is to provide flexibility to the investor given the volatility of the fund. However, in the product such as this scheme, investments are made in long-term bonds or debts with government security. Hence, there would be an exit load for a premature redemption of units within normally 1 year of the investment. So what they have written is a general knowledge on entry load and exit load. On purchase, there is no entry load. On redemption, they have given a full idea. When should entry load be charged? When should entry load not be charged? And there is a possibility that there may be a 1% exit load or some percent of exit load at the time of redemption within 1 year. This answer is there in your book. Do not write. Since such a load would be 1% or lesser, and this will enable the fund to liquidate the investment, in practice it is 1% or less if the lock-in period of 1 is not adhered to. But as per regulation, up to 7% exit load is permitted. This exit load will be credited to the income of the scheme after netting of taxes. So it has gone into, if they have charged, it has gone into P&L account. However, no inference can be made with certainty about the exit load for the lack of information given in the data. So if you write this way the answer, institute will understand that you have understood the concept of exit load, entry load. The fund has invested in treasury bill of the face value of 1 lakh amounted to rupees 90 crore. Now this is a different question, not related to this case study. Okay. Now we will take a break first, and after the break we will continue, okay, with this question number 13. Those who want to try during break time, you can try.